Somewhere in Britain right now, a young couple is signing the most important financial document of their lives. They have spent months searching, years saving. They have sacrificed holidays, nights out, and the small comforts that used to feel ordinary. Today is the day they finally get the keys. They believe they have made the smartest decision of their adult lives. But what if the foundation beneath that decision is cracking? What if the very thing that was supposed to secure their future is the same thing quietly threatening it? This is not a story about one couple. It is a story about a nation. A country that has built its sense of identity, security, and prosperity on a single belief: property always goes up. For decades, that belief has held. It has rewarded those who acted on it and punished those who waited. But beliefs are not immune to mathematics, and the mathematics right now are sending a warning that very few people want to hear. To understand where we are today, we must understand how we got here. Between 2020 and 2023, average house prices across the United Kingdom rose by more than 40%. Over the same period, wages grew by roughly 12%. Homes became dramatically more expensive. Wages did not keep pace. Affordability shrank. So the responsible question is simple: who is buying these homes, and how? In many cases, the answer is debt. Mortgage borrowing has reached historic highs. First-time buyers are borrowing larger multiples of their income than at any point in modern history. In London and the Southeast, purchases regularly exceed 8 times annual salary. Previous generations were limited to around 3 times income, not out of caution, but because it reflected sustainable mathematics. We have not made homes more affordable. We have extended the rope. For more than a decade, borrowing was historically cheap. Interest rates fell to levels never seen before in modern Britain. Millions made their mortgage decisions based on those conditions. Then, inflation surged. Interest rates climbed rapidly. Mortgage costs followed. A £300,000 mortgage that once cost £1,300 per month now costs closer to £2,000. For many households, that difference does not exist in the budget. And millions have not yet felt the full impact, because fixed-rate deals are expiring. Hundreds of thousands every month. This is not a crisis that has passed. It is a crisis that is still arriving. Behind many front doors in Britain, families are quietly under pressure. The house is still there. The car is still outside. But the margin is gone. They cannot refinance easily. They cannot sell without loss. They cannot move. They are trapped by the very asset they were told would secure them. Ownership costs have risen across the board. Council tax, insurance, utilities, maintenance. The mortgage was never the whole cost. But too many only calculated the mortgage. Following the financial crisis of 2008, institutional investors entered residential property at scale. Low interest rates made leveraged property attractive. They bought portfolios. They bought developments. They competed directly with first-time buyers. They needed only one thing: a return. Now, borrowing costs have changed. What worked at 2% does not work at 6%. Some institutions are quietly reducing exposure. More supply. Fewer qualified buyers. That equation is not stable. In Britain, home ownership is not just financial. It is identity. It signals stability, belonging. For decades, property felt transformative, but the belief that property always rises may now be the most dangerous assumption in the market. History shows that property markets can fall. In the late 1980s, British house prices dropped significantly. Negative equity spread. The human cost was real, even if it remained behind closed doors. Conditions today are not identical, but they are not unfamiliar. Transaction volumes are falling. Properties sit on the market longer. Price reductions are becoming more common. Next comes softening prices. Then, distressed sellers. And distressed sellers reset markets. None of this is guaranteed. Policy changes could stabilize conditions. Interest rates could fall. Intervention could cushion the impact. But households renewing mortgages in the coming months do not have the luxury of waiting. For homeowners, certainty now has value. For buyers, the question is not whether prices always rise, it is whether the purchase makes sense for your life long term. For investors, numbers must work independently of hope. If rental income does not service borrowing, it is not an asset. It is a liability. Hope is not a financial strategy. Sacrifice does not override mathematics. Britain has placed enormous faith in property. That faith is now being tested. What happens next depends on millions of individual decisions: borrowers, lenders, buyers, sellers. The quiet question remains: is the foundation strong enough to hold?